Good morning, everyone. Welcome back to the Schwab YouTube coaching channel. It's our Monday edition of Trader Talk in today's market. I am your host, Kevin Horner. I'm joining you from a relatively crisp but yet beautiful day here in Denver, Colorado. I'm joined today by my friend, Mr. Jeffrey Abalos. Jeff, it's great to see you, buddy. Happy New Year. How are you?
Happy New Year. Always great to get to start the week off with you, my friend. Thank you very much for having me on your show. Same thing, I think, more mild here in Phoenix, Arizona than it normally is this time of year, but I will take it because it's high 60s, low 70s every day. It's just absolutely gorgeous. Perfect outside weather.
Yeah, I'm not going to argue with great weather. Here in Denver, I got to go to the Bronco game yesterday, sat out there for kickoff at 70 degrees on January 4th. Absolutely shocking, but it has been a very dry winter thus far. Hey, we're going to start off this week with a look at the first full week of the market for 2026. Happy to be doing that, obviously, and Jeff and I are going to try and set the table for all of you. We are joined in chat there by Brent Moores this morning. You can say hey to Brent. Remember, we're available on X if you'd like to follow us, the best place to meet up with coaches when we're not hosting classes for you. So follow Brent and me there. Brent Moores, CS, Kevin Horner, CS. We'd love to have that follow. Let's go ahead and get to our disclosures so that we can jump into the news. Obviously, there was a lot going on this weekend, but we want to look at a bunch of charts with all of you. So please remember that our conversation here is exclusively informational and educational. Simply put, we do not make recommendations nor endorsements for any specific approach to trading the market. What we do here, however, is discuss technical analysis through a look at the charts. Remember, though, do not make decisions exclusively based on what you see in the way of technical analysis. We encourage you to make decisions based on a multitude of factors. More factors, more data points, more information can make your decision making a little bit easier on you. But remember, past performance, of course, no guarantee of our future returns. Now, if you're new to this class, what we do here is more analysis in nature. What that means simply is we're going to utilize the charts. We're going to look through technical analysis concepts and strategies traders might choose to employ in their process. But ultimately, we're just offering insights from a technical standpoint, trend analysis. We're going to look at the biggest stuff first, starting with the indices, working our way down into industry groups, sectors, etc., and try to answer as many of your questions along the way as we can. So please feel free to post. For the duration of our show, we're going to go about 45 minutes in total. And with that, Jeffrey, taking a look at the SPX. Now, you and I were chatting pre-show about the fact that by the letter of the law, we may not have the so-called Santa Claus rally. And I say by the letter of the law because there's some specifics behind that. So just to give everybody a little level set on the Santa Claus rally as it carries into January, what are those details? What are those specifics that line up with the Santa Claus rally?
Well, this is something that I touched on a couple of weeks ago when I was on your show, Kevin, but the Santa Claus rally is defined as the last 5 days of December, the first 2 of January. Now, if it fails to materialize, which right now, unless we've got a big bumper day, even more than we've already had this morning, if it fails to materialize, January as a month is down 70% of the time. The full year, by the way, is lower 75% of the time. But we could still be saved by the first 5 days of January. If the first 5 days of January are up, Kevin, the full year is positive 87% of the time, with an average gain for the year of about 15%. So keep an eye on that. Let's say that doesn't materialize. So the Santa Claus rally doesn't show up. The first 5 don't show up, but January does show up. January's positive. January's direction has correctly predicted the full year around 75% of the time. So a lot of traders, Kevin, are very involved in what's happening right now over these next couple of weeks and throughout the month of January, because it could set the stage for what happens for the rest of the year. But as you mentioned earlier, past performance is no guarantee of future results.
Oh man, that one just burned in my brain. Will never be forgotten. Try to be mindful of it every step of the way. You know, I think it's important to touch on the concept of the Santa Claus rally, but let's provide it in a slightly different context. Throw out the return details. You and I talked about it. We're not likely. Now, it's possible we could get a nice rally here in the SPX. We're up half a percent, to 60.6% of on a move today. it's possible we move to new highs. That said, even without a move to new highs, Jeff, we're still in trend here. We're holding the 50-day moving average. If we had relied exclusively on the 50-day, our instances beneath it have actually been your chance to participate. So if you're bowing out of the trend in the S&P 500 right now, Jeff, aren't you doing so a little bit prematurely? Oh, you're on mute there, buddy.
Yeah, I was kind of going for mute. I don't know if the viewers heard. I had the dogs in the background. They're getting excited for the new year. But a really good call out. You'll see it here with the 50-day simple moving average, I believe is what we're looking at, but then also the 20-period simple moving average. You really haven't seen somebody say definitively, this is over, this is done. Why? Because you haven't broken below and stayed below for a closing of, let's say, 2, 3, maybe 4 days holding. So you've got to touch off of the support level, whether you want to call it the 50, like you saw a couple of weeks ago, or the 20, like we saw last week. But not yet. I don't think for a lot of traders would we say, hey, this thing is done, time to start selling out of the market. Would it have been better if we had a higher high, call it December 15th, 16th, somewhere around that time frame? Sure, that would have been nice. But the fact that we did get it coming into Christmas Eve, probably a little bit helpful for those people trying to find that bullish argument and saying, hey, here we go. We've got some momentum. Maybe this can happen. So a little too early, I think, for a lot of traders to say this thing is over and done with.
Yeah, and that's ultimately the takeaway that I wanted to offer, Jeff. If you are a trend trader, the trend has not broken, right? Do you have some concerns? If you're looking at concerns where we are right now because we've moved into the 6,900 level, haven't been able to maintain or carry it for multiple days thereafter, I can understand managing positions. But if you're simply working against a trend, you've not been provided a whole lot of reason to be bowing out of your SPX. Remember that if you're trying to trade actively, it makes, for many traders, a lot more sense to adhere to a set of rules as opposed to feelings along the way. Now, if you're a feeling trader, the person who's kind of relying on their hunches and what have you, always important to be comfortable every step of the way. So if you're uncomfortable at these elevated levels, think about being positioned properly so that you can sustain some movement that would go against you. Remember, while we all believe that there's more upside, we want to because that's our general nature, it doesn't mean it's going to play out that way. So it's very important to be thoughtful about what might happen that you don't agree with. It can always wreck our portfolio. So being disciplined along the way is very, very important. And that discipline right now, I think for many traders, sticks around that 50-day moving average in purple, around 68.10 right now. So that's a level for many in the intermediate time frame to keep a close eye on in the SPX.
Great call out.
Jeff, thank you. Now, Jeff, we're going to skip on over to the NASDAQ 100. We're up 0.75%. My lines tell me that we've been watching this consolidate over the last few weeks in here. I'm going to clear out that drawing set, but it's still going to say the same thing, isn't it? Lower highs, higher lows. We're pinching together. For if you're the trader waiting for an understanding of the next move, it's likely got to be outside of these lines.
Yeah, good call out. And keep in mind, too, everybody, the tech sector is a lot of what's driving the S&P 500. So you're getting more breadth, meaning other companies are participating in the S&P 500's rally, if we want to call it that. But you're not seeing that here on the NASDAQ, are we? You're getting those lower lows like Kevin just mentioned. You're also breaking below and holding for a few days that 50-period simple moving average. Now, the good news is it came back up. Hey, maybe we just had a head fake. Maybe things could work out. I think, though, Kevin, a lot of traders are going to be looking at what happens this next week to 2 weeks, because as that wedge formation happens, there's generally something on the horizon that says, okay, either we're going up or we're going down. We've got an identity crisis and we need to figure out who we are. And that may happen sometime this week. I don't know that it'll be with the December jobs report, but it may be by call it January 15th, people start to see, okay, this is either going to be a continuation of that AI trade rally or, let's take some profits and sit on the sidelines for a little bit while the market figures itself out.
And it's just that, isn't it, Jeff? It's as simple as watching those levels. And for a lot of traders who've chosen to not add new money just yet to a group that's been a leader, they might just be waiting on the breakout or the breakdown and move below the white line. The uptrending white line there tells us that there may be a higher likelihood of lower prices. So if there's a higher likelihood of lower prices, how do traders manage it? Commonly, they'll take a little risk off. move a little cash to the sidelines, be ready to act for deployment if we get a bounce at a level that they'd appreciate. For some traders, Jeff, that might be that last low if we broke down here. This last low was a good bounce in the NASDAQ, and it provided us a decent pop back, and it could be a level to which we pull back and find support. That doesn't have to be. It could easily be the 200-day if we slip through to the downside. Again, I don't know what's coming, but what I do know are some of those levels that could help me as a trader set my risk for the positions I have on the table. That's what I'm ultimately trying to use technical analysis to do, is be able to manage my trades along the way. And that's kind of the process. So big scenario that could play out. But like I say, if you're waiting for trend decision, you probably can just sit on your hands and wait for the close outside of one of those two white lines. Now, let's move into the Russell 2000. We're also going to peek in on rates here. Jeff, initially, my first thought is standard action here. Break to new highs, throw back to a breakout level for a support test. What about you?
Yeah, very, very similar thought process. Here's my concern, Kevin. I going into, let's call it the November-December period, things were looking a lot better. You had that run up to the new high. You see rates coming down. I was like, oh, okay, maybe we're in a risk-on environment where people are starting to buy the small caps. Why? Because the lower rate means that they aren't paying as much on their loans. They're very rate sensitive. So that run up, great. Okay, things are looking positive. The smaller cap companies tend to lead the larger cap sectors, whether it's going into a recession or coming out of it. So I thought this could be good news as we are seeing the rest of the year. This could be a lead-in to a potential January rally. The fact that we hit that high, though, around December 9th or so, and we've come back, tried to get above it, failed, and now we're not only below that 20-period simple moving average, we're bumping our head right along that today. Says this is a location that traders are really keeping their mind and eyes on. Why? Yeah. Because they want to know, is this going to be the leader? Is this going to be what drives us through January? It certainly helped out to get a lot of positive momentum built into the market as we were going through the holidays. Now it's a matter of, can it follow through? Does this story continue, or has this saga come to an end?
Your guess is as good as mine, Jeff. Obviously, I'm waiting to find out the same thing.
Yeah, I have no idea. I have no idea what's going to happen, obviously.
I'm going to add another line in here because there seems to be a fair bit of overhanging resistance for us. These levels here were at 25.40. It was a nice extended tail. We pulled back. Yeah. We had a nice extended tail at resistance. We made a lower low in the short run before bouncing back. The downtrend line here makes a lot of sense for some traders. Many of you are going to trade a break of a downtrend line to the upside on a closing basis. That can give traders reason to start a new position. Ultimately, though, there could be some traders above saying, hey, I'm only going to buy on a close over 25.45 as an example, because that would appear to be clearing a level of resistance from which we've been pushed back. And I got to point this out, Jeff. The last time we were at that level on the way back up, look, we paused for 4 days at that level before we pushed through, and then it became a very quick top, not a held top. We had to come back and test support. Now, a lot of you traders who are following these plans, this process for entry and exit of your positions individually, you're utilizing concepts like this. Oh, I like to buy that first breakout, or I'm not the breakout buyer. I'm waiting for the support test, which may have just occurred on last Friday's price action. So have those levels, those rules set for yourself that will enable you to start a new position or exit those positions along the way. Those rules are going to be your playbook to success over time. Now, we're not telling you what those rules are. We're just reminding you of the importance to put those rules down, whether paper, physically, or digitally. Very, very important, no matter how you choose to do it. Now, Jeff, we got it. Since we're talking interest rate environment here, real tight relative to small caps, let's look at those yields. Pulling back again and yet tightening in here. That yield has just continued to bang its head on 4.2, and we're not popping through it. So I continue to be optimistic, but Jeff, something is underlying going on here. We're going to see something change in the near term, I'm wondering.
Yeah, well, correct me if I'm wrong. Were you highlighting those three circles because you were potentially seeing an inverse head and shoulders? Is that?
Yes, sir.
Am I reading the tea leaves right on this? Okay.
You nailed
it.
And
then you have that. Yeah, you have that come up into mid-December, maybe early December, and then you didn't break the neckline. So what does that say for a trader? Well, it says maybe that head and shoulders pattern is probably a little long in the tooth. It might not end up coming to fruition, but I don't think that that line is off the minds of traders just yet. I think that's probably where a lot of ideas are starting to get formulated. Hey, what if we break above 42? What if we stay below it? How are we going to plan out the rest of this potential treasury trade? Really good call out here, Kevin. Now, what exactly is going to happen? Ultimately, who knows? Looking at the news, though, you're starting to see some Fed folks say, hey, maybe we could get one or maybe two rate cuts. Some people starting to lighten up their language that were said, I'm absolutely not doing any more rate cuts. I won't mention who they are. You can look those up yourselves to all the viewers out there. But really good call out here, Kevin. That level that we are at right now, I think is really getting a lot of eyes for traders on do we go higher or does this break a little bit lower and the rates don't seem to come to fruition? What are your thoughts, though? I'm always intrigued and curious. Is that the line? Do you think the 200 is where the eyes might become focused next? What are you seeing?
I think 4.2 as a percent on yield becomes very important. Like I say, the last month, you can see what it's been. You called it out. I mean, if we're treating it like an equity chart, we're not necessarily doing so, but we're applying technical analysis concepts to the yield chart nonetheless. It's pretty interesting that we've run into that 4.2 and been pushed back. Equally interesting was the fact that that would be the neckline if it were an inverted head and shoulders as I've drawn in. But the thing that's got me on my toes, I'll just say, is the fact that we've held 4.1 since breaking it in early December. So that means we're looking at 4 weeks, almost, it'll be 5 obviously this week if we hold it, where we've broken the downtrend line in yields and allow that 50-day moving average to catch up. If this were a standard equity position, this would look like an opportunity for a bottoming pattern to have worked itself to fruition. So there's opportunity on the upside is the concern from this. This looks like a bullish chart to me, especially if it can clear 4.2. Now, if not, well, then I would look at this as continuing to keep the small caps in vogue, so to speak, continuing to push our XL, our real estate group, our utilities groups to the downside. You know, when these groups that are interest rate sensitive are going to be monitoring the same thing all of us are, obviously. Lower yields would be good for us across the board, I would say, certainly good for small caps. And that's kind of why we've been participating. I guess the real question now is, Jeff, maybe what's happening is a shift in yield behavior simultaneous with the markets growing more comfortable with a slightly elevated yield, perhaps.
Yeah, really good call out. Yeah, maybe this is considered the new norm for folks out there. How do we make money in a slightly higher interest rate environment with what the Fed's doing? So really good call out, Kevin. I like that. Yeah.
Well, let's see what our leader is doing, right? Let's go check in on the semis. Semis had been our strongest group for much of last year. In fact, had a great year collectively. And Jeff, we've broke into the upside here on the open.
Yeah, you've got a new high. That's what we're seeing here. New high. Highs generally beget highs. And this is not me saying that this is going to continue. I obviously have no idea what's going to happen. But generally speaking, when you're looking at a new high, people are saying, okay, this is more bullish than it is bearish, especially a big pop like this. What could that say? Well, this might be a time where you do that big start of the flag pattern. Up, 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 up. Takes a breath, comes back down to that support level. Great, we found the support level, and then it continues that trajectory. Certainly, I think a lot of traders out there, Kevin, are going to be looking at that 8,000 level. That's just natural. That's human nature. It's one of those psychological numbers. Are we or aren't we? Those are the conversations you'll start to have. But if you can hold this level where it comes up, pulls back down to that previous high, we'll call it, I don't know, 7,400 or so, something about that level. Yeah, sure. You can hold that level. That may be a conversation for those of you that are saying, I am very bullish in the semis. I am looking for that flag pattern or that pennant pattern to start to continue its formation. But you do need it to come up and hold that previous resistance level, Kevin. If it does not, then that flag pattern has been busted.
Okay, well, that's so again, adhering to a set of rules and a definition of our patterns, very, very important. difficult to argue with a 1.75% move to the upside, even though it looks a little red because of where we opened today. A strong move in the space. Now, we could also incorporate a quick look at software, which has been moving itself. Now, if I bring this up, I like to utilize my Dow Jones US indice letters here. Jeff, what I find intriguing about this is not nearly as bullish as what you're seeing in the semis.
Yeah.
And more important than anything else, I think, is the rejection at a level that looks to be perhaps what many traders might call a neckline of a double top. What do you see?
Yeah. I mean, I can't deny that at all. Now, I'm curious, are we kind of, I guess I'm throwing this question to you, but to the audience in general, love to see the comments on this. Are we saying this is a divergence, that there are now going to be some winners and some losers? We're picking certain sectors over others, certain companies over others. Is that what's going to be happening in 2026? Is this a stock picker's market? Curious on the viewer's thoughts, but also curious on your thoughts, Kevin. As you see the semis doing really great, but then you're looking at the software and it's saying, well, maybe this is a different story. What do you pull from something like that? I'm just curious.
Yeah, I wish I had good answers for you. Unfortunately, what I am going to do is what I traditionally do. I'm going to monitor these trends. This is a divergent viewpoint, though, right? The pattern you're seeing in the semis is bullish, and this is bearish. Bearish, at least in the sense that having rallied back after making that new low or that matching low back here, we rallied into resistance and have now failed at resistance. I guess the question is, can we hold the level that has been now established as short run support before maybe turning this into a deeper pullback? The concern here, obviously, is relative to the 200-day moving average. We're below all three of the big ones now, Jeff. So we're in danger, as I see it, if you're looking at software. It's not a group that has held up over the last month. In fact, you've seen this shift quite a bit. And I thought it was pretty important because it's always good to look at as many of these groups as possible so that you can start to see where opportunity might reside. Jeff, if we move off of software and back into, out of tech, right? We've seen broad tech with the NASDAQ moving to new highs. You see semiconductors leading and software lagging. But what about transports here, where you've got a group moving to essentially new all-time levels here? Let me clean this chart for y'all real quickly here. Take a look at this, Jeff. This looks like a fairly bullish setup in the short run, working against a 20-day moving average here after a brief consolidation.
Yeah, big move today, this morning. You're holding that 20 nicely. I would do, like you talked about, Kevin, it's all about your process. If you're looking to do a trade in the transports, what's your risk to reward? Well, my risk is coming down and potentially breaking below that 20 period. That's just an example. I'm not actually saying this is a trade I would take on. But let's say that's the risk that I'm looking at. Okay, where am I looking at it to go to? You just take the measured move, the difference between those two white lines. If it pops and breaks above its current high level where it's at today, that's where I would anticipate this going. And then what does my process say? Well, if I can hit my resistance level, meaning my new high level coming up to that measured move, great, I'm going to start taking some profits off the table. If it doesn't materialize, you get some pretty decent feedback pretty quickly, don't you, Kevin?
Yeah.
Well, didn't hold the 20 period simple moving average? Okay, I'm out of the trade. Mark that and move on, find the next opportunity.
Yep, that's exactly right. Again, what I loved about what you said is nothing specific to any one trader, but a plan that you're just looking at the rules that you made for yourself, right? Remind ourselves, of course, that the measured move, whether you calculate it, I calculate it, an analyst says this is the price target, they're never going to be a guarantee to be achieved, but they're, at least from the measured move standpoint, it's a way that traders would approximate an exit strategy. Jeff, you called it out. It's about a 400-point level, I think, that we're looking at here in the transports. Actually 350, let's call it 17,350 up to 17,700 or 17,750. I guess about 400 points. So that would give you an opportunity to see 18,000, 18,100 from that approximation of a measured move. But again, no guarantee. But what's interesting about it is what we know about this space, Jeff. There's three big pillars here, right? You've got your planes. So let's quickly hit up the airline stocks. Well, that looks like a bullish continuation pattern after testing the 20-day. We can do the same thing or something identical with the rail stocks. Taking a look at the rails. Why is that chart? There it is. So the rails have pulled back after meeting some resistance there, but coming into an area
Okay.
of potential support. And then the other one, we'll just hit the truckers real quick. And then that looks a
Okay.
lot like that airline one, doesn't it? Now, Jeff,
Yeah,
this is
right.
not negative because when truckers are moving things across the country, it tells us perhaps that our economy is strong. I mean, truckers would not be moving stuff across country effectively if if our economy were weakening. We would tend to think that that would be a little bit of a leading thought process. So
Yeah.
what do you take from this analysis, these last three charts with the Dow Jones transports?
Well, I love that you called that out. A lot of people were worried about consumer sentiment, which is one of those soft numbers, how you feel. But the actual math behind it, when you look at the spending over the holiday season, was actually still pretty good. So it could be a bumper holiday season. We'll find out as the earnings start to come out a little bit later this month. Really good call out on that, Kevin. One of the other things that people might want to keep in mind is generally during a softening of the market. Let's say you're going, okay, all right, okay, I see this happening here in the transports. We've still got some momentum there. What about the overall bigger picture story? Kevin, if you look at a slowdown period, and I don't know if this is happening or not, what you would generally expect to see are things like financials outperforming, healthcare outperforming, consumer staples outperforming. So as you're going through and you're looking at your process, and for the viewers out there that are saying, what should I try to identify as we come into the first part of the year? Those three sectors might be your leading indicators if there is a rotation away from that risk-on mentality. If not, if tech continues to lead, if consumer discretion starts to continue, if you've got the communication services continuing what they've been doing, then it's still a risk-on environment. In that case, what do? Follow your plan. If your plan says in risk on, I go a little bit further on my loss limiting strategy, okay, great. I go a little bit further in letting my winners run, that's fine too. But the focus is, like Kevin mentioned earlier in the show, stick to your plan. Plan your trade and trade your plan.
Love that concept so much, Jeff. I'll tell you what, it's I can't say it's one that's going to lead to a trade being positive every step of the way, but what it does do is probably gives you some comfort to act when you need to, and that's really the most important thing. You know, you're giving yourself known levels in advance, and then you're taking action based on stuff an analysis you've done unemotionally, which is probably the biggest key factor to it. So, Jeff, when I pulled up the heat map, I noted we're getting a little bit of a push there in financials. You called financials out as a potential leadership group in a slower market. But, Jeff, they've really been pushing fantastically. We're going to move into a little bit of sector discussion here, everybody. Financials up 2% today nearly, with what looks like, again, a fantastic, just appropriate pullback to a short-term moving average, the 20-day. Huge tail there on Friday. And today, not just a follow-through, but a push to all-time highs in the sector.
Gosh, and isn't that what you would like to see? If you're somebody that's bullish on a certain sector or even a company, you get this drop down, red day, red day, red day, red day. Here comes the 20-day. Here comes the 20-day jumping in to save you. Forms a little bit of a support, and now you've got this big, giant bull candle happening today coming into the early start of January. So that might be a potential area of focus. We've seen this group, though, Kevin, like you're showing on the chart here. This has been leading ever since early December. It's going higher and higher and higher. It broke past that high, came and consolidated down, as you see from those two white lines that Kevin drew nicely a couple months ago. Then you've got that pull back up, drop back down, found support. This is, if you're a market technician, somebody that likes to look at charts, this is a classic bull movement, higher highs and higher lows. So as they say, Kevin, the trend is your friend until it bends, and that is when it ends.
That's right. That is the idea, Jeff. And, I just got done talking about the concept of the trader who buys on the breakout versus the trader who waits for a support test versus
talk to us.
Right, and that's all that's going on here. Look, doesn't matter which of those traders you are. Do you buy on this initial break here? Do you wait for the support test? You got a support test and then it took off to new highs. Great. Did you buy on that new high, or did you wait for this incredibly this beautiful bull candle right here? I mean, this is a nice candle off a support test. Clearly, what happened here was you had all the buyers stepping in saying, "Well, that's a ridiculous level. We can't validate that. So these are great levels we should be buying at," and that's exactly what happened. And now you've pushed up to new highs. So this is a bullish look. Remember, new highs are not bearish in nature, and it's what's key to this. I think everybody is what And again, this is not to pat myself on the back. It's just to remind you of why we need to do the analysis consistently. You who've been here with me for the last 3-4 months, we've been talking about the need to break through this level and what could happen when we do. Well, what could happen is what is played out here in financials. We're going to see, Jeff, something similar in the industrial space. So let's look at the XLI, or pardon me, the industrial sector, pardon me, not the symbol. So the industrial index here did almost the exact same thing here, Jeff. Breakout, a little more patient in its move, but it found its 20-day on Friday as well, didn't it?
Yeah, very similar story. I don't know if there's anything that I could add to that, Kevin. It's a very similar narrative to the financial sector.
All right, well then, in that case, let's talk about the one that I'm sure people are wanting to hear about a little bit today. Let's talk about what's going on here in oil. Now, I'm going to be utilizing some symbols here. We're going to have a discussion around what occurred this weekend with Venezuela. It's going to be very general in scope because we don't know a whole heck of a lot, Jeff. The first thing that we have to point out is that we're utilizing future symbols here. What that means is these are a way to track your values. But remember, we're not talking about trading futures. You need to be approved to trade futures in Schwab accounts, and you do need to go through the process to do that. So we're not speaking about it from a trading standpoint. We're utilizing it from an understanding of trend. And I think the biggest takeaway, Jeff, is even since this weekend, there's not been a whole lot of volatility yet, has there?
Yeah, no, I think that what that speaks to is the general idea that people are sitting on the sidelines waiting to see what happens. They don't know if this is a good thing. They don't know if this is a bad thing for the oil market overall, Kevin. Now, what could transpire out of this? Other things, a domino effect may start to happen, and you're going to have to do a lot more reading, and I'm not going to be able to do a talking point that's going to encapsulate the entire story on that. But what I think traders are looking for is, does this signal a broader trend overall in the market where somebody says, hey, we were okay to go into Venezuela and make this happen. Do we now go into a country like Iran? That could be a yellow flag moment for a lot of traders going outside of the oil market. But as it relates right now, Kevin, I think people are digesting this move as, hey, this doesn't really seem like a whole heck of a lot. I don't know this is going to impact OPEC. I don't know this is going to impact the U.S. oil supply. So very, very muted response overall, I would say, Kevin.
As it relates to the barrel, I completely agree. Now, you can see energy as a sector has broken out, and this is notable, Jeff, and you can see why when I lift my rectangle off of here. You can see what's been going on. I can even make this a 2-year or 3-year chart, and you can see the same pattern here. This looks a little more significant now.
Right. Yep. Good call out. Good call out. And nobody knew that. Well, I'm sure a few people had an idea, but you could say the overall market didn't know that this date was set in stone, that something was going to be happening, but yet you have that wedge pattern forming all the same. And then what do we look for? You look for a new situation or an announcement that causes a break up or a breakdown. In this case, Kevin, you had that break up, now giving you a more bullish indicator as opposed to a bearish one on the oil market. And
so, Jeff, the reason I bring this up is some quotes out of the president here based on the military action taken this weekend. Quote, we're going to have our very large United States oil companies, the biggest anywhere in the world, go in, spend billions of dollars, fix the badly broken infrastructure, the oil infrastructure, end quote. To me, I think what you're seeing here is an action tied more to the underlying companies, the builders, and the exploration, if you will, as compared to what's going on in the price of oil. That's where this may be notable, right? This is not necessarily, at this point, we haven't seen oil prices move, but we have seen our oil companies and those in that grouping be the leaders here, or one of the groups moving out of this fairly significant consolidation, Jeff.
I love that. Great call out. What a good diversification of, hey, there's oil, the barrel itself, and then there's the company that helped to produce these barrels. Kevin, really good call out, buddy.
Now, I want to point this out. I don't know what companies are already based in Venezuela, U.S. specific there, Grumpy Gene, but I think what the president is stating is his expectation is to move into that area, to move more U.S. companies into that space. I'm certain there are some there already. I do not have that level of legwork done, so I'll apologize in advance there for not having that level of detail for you. But keep an eye on that space. I think that's an area for monitor going forward. Another thing that we didn't look at here, Jeff, I thought we could peek in on at the request of someone in here. Oh, I wanted to touch on this first. Probability trader, thank you for mentioning this because we were looking at the future symbols. I think it's always important to know we do have more discussion available for you relative to futures. James Boyd does have that class utilizing futures in the morning. Ben teaches one on Tuesdays as well, talking about the pre-market evaluation through the use of the future symbols to get a picture of what may be happening there in the time frame leading up to the open. So keep that in mind. Thank you, everybody, hitting me up with Chevron. It looks like that's got your biggest position in terms of exposure to Venezuela. So thanks for the collective getting answers to the team. Thanks, everybody. I wanted to hit up Bitcoin because there's been a little bit of a bounce here. Same thing applies as it relates to the future symbols. But Jeff, the thing that stands out to me here as I go back to a 1-year chart is as usual, the level to which we have rallied. What are your thoughts on what you're seeing here?
Yeah, Bitcoin has been more of a gauge in a lot of traders' mind that I've been talking to, Kevin, as a risk on or a risk off mechanism, almost like a soft survey, but with hard data. And in that, I mean, if they are risk on, you're going to see Bitcoin starting to rally. If people are more risk off, you're going to see Bitcoin starting to drop down. Here you have a risk on mentality. Over the last couple of hours and in the last few days, people are more risk on. So you've got that rally into that 93,000 level or so. Yeah. Will that break above? That 50-period simple moving average has gotten a lot of attention. If you go back in June, that was your support level. You come back to the August section, that was your support level. Tried to break past it in September, failed. A lot of eyes are looking to be on that purple line, that 50-period simple moving average, Kevin. I would imagine that's where a lot of traders are saying, hey, if we are going to continue a rally in Bitcoin, we're going to need to get past this level. If we can't, maybe it's going to be muted for the next little bit. What are your thoughts?
Almost exactly what you said there, buddy.
Okay.
All of this action here, rallying into 94 and pulling back, matching lows. Matching lows stand out because it is a bullish divergence at that last low, Jeff. You'll notice here we made this essentially, if you throw out the crazy tail we got here on this day back in November, a lot of traders would say that this pullback here was basically a matching low and a higher low in the RSI, so a bullish divergence. But more than anything, I got to point this out, Jeff. In my experience, what traders look for with a bullish divergence kind of validates this level of support. So it gives them more confidence that this ledge at about 85,000 can maintain as support. However, what it doesn't portend is a breakout necessarily. It may have already played out that bullish divergence to rally into resistance. So this becomes a very important area. Downsloping 50-day has a greater potential to act as resistance than it does to allow a breakthrough necessarily. But what it does tell us, I think, is that's a pretty important level there, right around 94, 95, Jeff, from a resistance standpoint.
Yeah.
Okay, Jeff, let's see here. Oh, how about precious metals? I know everybody's been wondering about what's going on there. The last show that I hosted a week ago, we were talking about the precious metals quickly, and things were pulling back, and they've made their pullbacks, Jeff, but also reasserting some trends, it looks like, here with the gold.
Yeah, I've got a few clients that I've worked with, Kevin. As a lot of viewers know, I cover the Southern California, Arizona, now Nevada, part of El Paso, a couple other states. A lot of them are talking about, hey, should I be putting my child or my grandchild's college money into silver or gold? And I think this is way off base from the client mentality that I was talking to even a year or so ago. So what is happening here? More risk on in the metal space. Now, what I would be cautious of for a lot of folks out there is metals, sure, they do have a need in your portfolio. Absolutely, there is a certain amount that you want to get in there just for diversification purposes. What I would be careful of, everybody, is starting to say, hey, look at this. Look at these metals doing so great. Let me just go headlong and start investing or start bullishly trading something that I know very little about. I would say, Kevin, for a lot of the viewers out there, you got to do your research on this. Why do precious metals start to rally? Why do we use these products? What exactly are they going into? And is that something that I want to get behind? Is that a narrative I'm looking for? As it relates to the chart, just the market technician in me, like a lot of things, holding that 20-period simple moving average, came back down. Okay, what is that telling us? That might say that people are still risk on, but that 4,600 level, Kevin, I'm sure is on the mind of a lot of traders out there. So if you're saying, hey, I want to take a little bit of a trade, maybe you look to your rules. What's my risk? My risk is coming down and closing below that 20. What's my potential reward? Getting up to that 4,600 level. I don't know, Kevin. That's a 50-50 shot. I'm not too sure that a lot of traders are going to take that. What are your thoughts?
I'm thinking there's going to be many a trader who's looking at these as, oh, they're acting like tech stocks. You know, these are trades that, I'm just going to have no choice, but I got to trade these. And the truth of the matter is, this is not that space. That much we know. So what's going on in this space feels a little bit like FOMO. It doesn't mean it invalidates the moves, but it does mean that perhaps we're seeing some traders moving into a space that they've previously never traded. And what you stated as it relates to the allocation of gold and silver in small percentages to long-term portfolios makes perfect sense. But that's no different today than it was 3, 5, 10 years ago in reality. And the reason I say that, Jeff, is that this is, look, markets move in cycles. The cycle we may be looking at as it relates to gold and silver might be a larger cycle under development. That's entirely possible. But I think you'd be hard pressed to find a long-term asset allocation advocate who suggests that you should be investing a different percentage than what they would have told you, say, 5 years or 10 years ago, which is to say limited in scope, small percentage relative to an equity or equity and bond portfolio, for example, Jeff. I just don't think that this is these are not different situations than what we've seen historically, is what I'm saying.
Good call out. Yeah, you're normally finding metals doing really good in recoveries. That's generally when these things are going just gangbusters. Expansion period still doing really well. Slowdown, that's when they start to underperform. Certainly in a recession, that's their absolutely worst performance of the cycle. So keep an eye on that, everybody. Watch out for those levels. Make sure you plan your trade and trade your plan, as we mentioned before.
Yeah, we're going to have to hammer that one because that never gets old, Jeff. All right, buddy, we're in the final couple of minutes here. As the guest, I want to give you an opportunity. Maybe there's something that's caught your eye this morning, whether it's a sector or maybe an individual stock in the news. I want to give you the final word of the day.
I would say, can we take a look at some of the big drivers? Can we look at NVIDIA? Can we look at Microsoft? Can we look at Apple and the Mag 7? Again, these are the underlying companies that are driving a lot of the market momentum. So here for NVIDIA, you've got that high that happened back in October. Still hasn't regained that, though you do have a little bit of help coming from that purple line, that 50-period simple moving average at, we'll call it about 187. So a little bit of weakness on one of the largest companies in the world, if not the largest still, and the biggest component of the S&P 500. Kevin, can we try Microsoft? Unless you had a comment, I want to make sure to give you the opportunity to chime in. Okay, weakness in Microsoft. This is not great if you're saying, let's look at the underlying of the S&P 500. Very big company, very big driver of what happens throughout the entire world. And right now, it is below the 200-day simple moving average. Ouch, that's not great if you're somebody that's bullish on that. And then lastly, can we jump into Apple? That's also been getting a lot of attention. I've talked to a lot of clients over the last couple of weeks that are in Apple. What do they say to me? Jeffrey, what happens when that orange line goes below the purple line? Is that bad? Does that mean anything? That's what we call a bearish cross. It's not ideal if you're in the bull camp. What you don't want to see is your moving averages having the shorter cross below the longer if you are bullish. Here you've got the 20 still above the purple, which is the 50, but you're getting dragged down by the price action, aren't you, Kevin? We're going lower. It is very likely, if this trend continues, and that's a big if, that 20 will go below that 50-period simple moving average. That may be the point for a lot of traders to say, hey, you know what? I've made some really good money in Apple. Let me start taking some of my profits off there, also adding a little bit of weakness. So those are some of my final thoughts. I hope that was helpful for the viewers out there. Want to leave it to you for the final discussion point.
I have no doubts that it was helpful to our viewers, Jeff. That's one of the reasons I get you back every single month, buddy. As you can see, I obviously have a newly established equity position in my example portfolio with an example trade on Apple. I've got an order for exit there. I'll be talking about this tomorrow on our newest class, Building a Stock Portfolio, which is really just an upgrade of the class that I was hosting called After the Close, which we just rebranded. And we're going to lean a little more heavily into equity management, starting small positions, building around them, utilizing trend analysis to aid us in adding to positions that are winning or taking some risk off along the way. Basically, everything that we talk about here from a trade management standpoint, we're going to bring that into the Building the Stock Portfolio. So if you're looking for that type of discussion, join me here tomorrow at 4 Eastern for that class. I'm looking forward to kicking that one off tomorrow. The other thing that I'll quickly point out was Microsoft, and you hit it, but Microsoft's chart looks a lot like that of the entire software space that we looked at earlier, Jeff. So I'm just going to have to keep a close eye on that because obviously we want to see some improvement out of one of our leaders. But as always, Jeff, a wonderful discussion with you. Thank you so much for being here today. Big thanks to Brent Moores here in the chat. Don't forget, there's more to come from us all day today on the channel, so keep it tuned right here. But follow Brent and me on X. Hit that thumbs up if you like the discussion today. We're going to get this one back and into the archives after a quick review for other viewers. So your thumbs up helps us out quite a bit in YouTube. So with that, have a great rest of your Monday, everybody. Thanks for joining. We look forward to seeing you all again real soon.